We mentioned in a previous video that the Federal Reserve, or the Fed, is in charge of monitoring and modifying the monetary supply. And they do this through monetary policy. Let's just say we have a pile of cash that we can call the monetary supply. And if the Fed enacts certain policies, those policies can be utilized to increase the monetary supply, and we would call that a expansionary policy because we're trying to expand it, or a loose economic policy, or the Fed can enact tools that will go ahead and cause that monetary supply to shrink and get smaller. And we may want to go ahead and increase the monetary supply or apply a contractionary monetary supply or a tight monetary supply to make the monetary supply smaller. Remember, expansionary policies cause the monetary supply to increase, and typically when we increase monetary supplies, we are attempting to strengthen the economy, make it stronger. And when we are decreasing the monetary supply or providing a tight or contractionary policy, we're typically trying to shrink the monetary supply because of challenges with inflation. The Fed is able to enact three main tools of monetary policy. The first tool is called the required reserve rate. And the third main tool of the Federal Reserve to enact monetary policy is called open market operations. These are the three tools that the Federal Reserve can bring to bear to provide either a contractionary or an expansionary monetary policy. Let's discuss the three tools individually. The required reserve rates. When you and I deposit money into a bank, they are not required to keep all of your money in the bank, but the required reserve rate is the percentage of funds that are legally obligated to remain in the bank. Let me give you an example. Let's just say you bank at Chase Bank and you have deposited in your account $100,000. Of that $100,000, when you created the account at Chase Bank, and there were lots of signatures to make, one of the pieces that you did is you gave the bank an opportunity to go ahead and utilize a portion of your deposits in the bank's best interests. If a bank is making a car loan, where do you think they got the money to make that car loan? If someone has a home improvement project and they go to their bank to get a loan, where do you think the bank gets that money for the loan? They get it from a portion of loanable funds, which is a portion of the funds that their customers have placed in the bank. The required reserve rate percentage is typically somewhere around 20%. So if you had in the bank $100,000 of that required reserve rate, the bank is obligated to make sure that you have $20,000 of cash on hand for your use, and the paperwork that you signed gives the bank the possibility to take $80,000 of your money out as loanable funds for vehicles, boats, college funds, whatever they're loaning the money out for their customers. And typically what happens as they send out a loan, it gets repaid back and the bank earns interest on those loans. These loanable funds get out in the economy and consumerism occurs, and people will go ahead and buy cars, and the auto dealership makes a little bit of money. So as loans are funded out to people, they directly go into the economy and strengthen the economy. So if the Fed was interested in taking our monetary supply and expanding it, they want to increase the amount of loanable funds. So the the Fed would tend to go ahead and modify the required reserve rate. So if they want to have a loose or expansionary policy, they may take the required reserve rate and decrease it to 10%. Remember, you still have $100,000 in the bank, and with a new required reserve rate, the bank is obligated to keep $10,000 of your money in the bank on hand for you to utilize as cash, and they're going to have $90,000 that they can loan out. There's more money now in the monetary supply. Consumerism is occurring, and the economy begins to strengthen because we have expanded the monetary supply. So by decreasing the required reserve rate, we would tend to increase loanable funds. So all the Fed has to do is communicate out to banks the required reserve rate is changing. If we were in times of great inflation and the Fed wanted to go ahead and decrease the size of the monetary supply, a similar principle would apply. They would go ahead and apply a tight policy, also known as contractionary. And again, they're trying to modify loanable funds, and in this case, decrease the loanable funds. So they could very simply communicate to banks, we are now requiring you to have 30% of your funds available for cash for your customers. You still have $100,000 in the bank, and now the Fed is requiring the banks to hold on to $30,000 of your money, and there is now $70,000 in loanable funds. So the Fed can go ahead and modify the monetary supply and provide a monetary policy utilizing required reserve rates. If they attempt to expand the monetary supply, they'll tend to decrease the required reserve rate and apply a loose monetary policy. And in times of inflation, they may want to enact a tight monetary policy. And when you have a tight monetary policy, you tend to increase the required reserve rate. And again, we're paying attention to what happens to loanable funds. Now, Just so we're clear, as the required reserve rate occurs, your $100,000 is still your $100,000. And based on the required reserve rate, the banks have promised that you'll have a portion of that cash on hand. And depending on what's happening with their loanable funds, you may walk into the bank and say, I need my $100,000 right now. And if they have the cash on hand, they can give you your $100,000. However, when you signed up for the bank account and you read all that fine print, you're going to recognize that somewhere in that fine print, you gave the bank a opportunity to hold on to your money, and if you walked in and demanded it, if it's a very large sum like $100,000 or $500,000, big money, then the bank has, I believe it's 5 business days to get you your money when you close your account. Now, I hope all you guys have the problem that you have $100,000 in your bank. It's not a problem that I have. But if you do, just be aware, if you go to close the account and you have big bucks in there, the banks have a little bit of time to gather up the loanable funds, add that to your required reserve money, and reimburse the entire amount that you have in the bank. As a small caveat, the required reserve rate is typically about 20% in society at most banks. If you are banking at a rural bank, and what that means by a rural bank is it's a bank in a very rural setting that doesn't have any competition. There's not a lot of other banks around, and it's the only location that the citizens in the area have to bank. Their required reserve rate is typically a little bit different. If the normal required reserve rate is 20%, a rural bank may have a required reserve rate of 17%, meaning that they are able to provide a greater percentage of loanable funds to serve their community so they can buy houses, buy boats, send their kids to college, whatever they may need the loan for. Is also the base interest rate for all lenders. So the discount rate is the prime rate or the interest rate that all lenders utilize. For our example right now, let's just say that the discount rate is at 5%. And let's just suggest a bank had $1 million of funds to loan to people at a 5% interest rate. $1 million at 5% means that they have to get paid back, particularly if they got the loan from the Fed, $50,000 of interest, or if it was profit out of their loanable funds, they'll profit $50,000 for a grand total of $1,050,000. That $1,050,000 is money that can be utilized in consumerism and the monetary supply. And it's money that if we can increase it, if we can make it get a little bit larger, then that has a general effect of increasing the monetary supply and strengthening the economy. So how would we make this pile of money larger if we were able to take the discount rate? In a loose monetary policy, the Fed would decrease the discount rate. Here's why that's important. If all of a sudden bank loans got to be a 2% for the loan, would you want to get a loan? At 2% money, if that's what the bank is loaning out, or 2.25%, do you really want to get a loan? So what happens is a bigger portion of this $1 million, more of this $1 million comes out, and everybody wants the money because the interest is so cheap. And we'll end up paying $20,000 in interest. However, what we'll note is not only will more people want the money once the interest is paid back, there's been a more of a total amount that's been off in the economy. Note, on the green line, I went back in and I fixed the math. 100,000 minus 50 is 950,000. So at 2%, more people are going to want to get a loan at 2%. That's a great interest rate. So if the Fed wants to expand the monetary supply and provide a loose monetary policy, all they need to do is decrease the discount rate. So because the interest rate has gone down, people are more likely to go on out and get loans and increase the monetary supply. In the end of 2020, because of the challenges with the coronavirus, the Fed has dropped the discount rate below 1%. And they're essentially encouraging people to go on out and get loans and spend that loanable money at a very, very low interest rate to expand the monetary supply, to jumpstart the economy, to make it stronger. However, there may be some times when inflation is going strong that we may need to go ahead and decrease the monetary supply. And in times like that, the Fed would apply a tight monetary policy or a contractionary monetary policy. And in a contractionary monetary policy, the Fed tends to increase the discount rate. Let's just say the discount rate was increased to 10%. At a 10% loan, how many people want to go out and get a loan at that amount? 10% is very, very high for a house loan or for some car loans. So as the interest rate goes up and interest needs to be paid, two things happen. There's, of course, less money out in loanable funds, but less people have a desire to get a loan at a higher interest rate. So if the Fed wants to make a quick change to the economy and either strengthen it, make it stronger, or provide a tight monetary policy, one of the best ways to do that is by utilizing the discount rate. So the Fed can monitor the monetary supply using monetary policy of the required reserve rate or of the discount rate, or maybe both. The final tool that the Fed uses is one called open market operations. The open market operations is simply the government's ability to buy or sell treasury bills. They're buying or they're selling. When we take a look at the monetary supply, remember, this is the money that you and I have available to participate in consumerism. The more money that people in the United States have in their pockets, typically the more they spend. We're pretty good spenders. Now, one of the pieces that people can do with the money in their pockets, they can choose to make investments. They can choose stocks, bonds. There's lots of areas that they could participate in. One of them would be buying treasury bills or T-bills. Now, one area that makes treasury bills unique as an investment is as you purchase a treasury bill from the United States government, you are guaranteed in writing your return. You are guaranteed the amount of money you are going to make. If you spent that same money in the stock market, you would not be guaranteed a return at all. So open market operations are very, very safe investments. So many people will purchase treasury bills or T-bills to go ahead and have a guaranteed return on their investment. They typically do not yield as much money as the stock market may, but it's a guaranteed investment. You will make money. The government has two options in open market operations. They are either going to buy treasury bills or they're going to sell treasury bills. So the concept is pretty easy to consider. If the government sells you a treasury bill, you get a treasury bill. Congratulations, you have a guaranteed investment. So as a person of the world, congratulations, you get your own treasury bill. But in order for you to purchase a treasury bill, what happens to your monetary supply? You have to give up a part of your monetary supply to get the treasury bill. So as the government sells treasury bills, the monetary supply decreases. Of course, consumers have a treasury bill that may have a 5 or a 10-year maturity date, and that is a long-term investment, but the monetary supply gets smaller. So when we sell treasury bills, there is a decrease in the monetary supply. And when the government buys back treasury bills, what happens with the people we have to give our treasury bills back to the government but what does the government give back to us? They bought it. If they buy something from you, you better get cash. And so by buying it, cash plus the interest goes back in to the monetary supply. So as they buy and buy and buy T-bills, the monetary supply increases. So when they buy, the money supply goes up. So as the Fed is attempting to strengthen the economy to make it stronger, they're trying to put money into the monetary supply, and therefore they would buy back treasury bills. If they are trying to slow down the economy because of inflation, they would tend to sell treasury bills to the population to take money out of the monetary supply. So with the monetary policy, remember the monetary policy is designed and is put together by the Fed. And they have several tools. Tool number one that we discussed was the required reserve rate, and it affected loanable funds. We also discussed the discount rate. And finally, we discussed the open market operations. So as we consider the monetary policy, if you were the chair of the Fed and you were to go ahead and enact an expansionary policy, so again consider what would you do if you were called to provide a contractionary monetary policy? How would you change the required reserve rate if you're trying to then make the monetary supply contract, make it smaller? When we look at our loanable funds, we're trying to decrease loanable funds, and we do that by increasing the required reserve rate. If you were trying to discourage people from getting loans, what would you do with the discount rate? I bet you if you increased it, or increased it a lot, people would be less likely to get a loan. And if you're using open market operations and you're trying to go ahead and take money out of people's hands, if you sell them treasury bonds, they will give you money and the monetary supply will decrease. So if you understand expansionary and contractionary, you'll understand loose and tight monetary policies. Because expansionary, if you're trying to expand it, you have a very, very loose monetary policy. The visual picture I get is your hand is very, very open. It's very, very loose, and the money is able to flow. So with a loose monetary policy, you want to, again, increase loanable funds. So you'll decrease the required reserve rate. You want people to get loans, so you would decrease the discount rate. You want people to go ahead and have money in their hands, so you would buy out the treasury bills. And with the tight monetary policy, again, you're trying to decrease loanable funds, and you do that by increasing the required reserve rate. If you have a tight monetary policy, think about this picture. You have the money in your hand and you're squeezing it tight. You don't want that money to flow. You want to compress it. You want to contract it. You want to make sure people can't get to the money because inflation is probably going crazy. And you would do that by increasing the discount rate. Or you could sell the Americans and others treasury bills, and that would create a tight monetary policy. What if you were told as the Fed, we are entering a recession? Federal Reserve, help us get out of the recession. How would you accomplish that? Utilizing the required reserve ratio. If we're in an inflation, in a recession, we're trying to get people to spend money. And if you want them to spend money, you have to increase loanable funds. How do you increase loanable funds? You do that by decreasing the required reserve ratio. And if you're trying to get people to spend money and utilize consumerism to jumpstart the economy again, you're going to go ahead and decrease the discount rate. If you lower the discount rate, lower the interest rates, people are more likely to get loans. And on the open market operations, you would begin to buy treasury bills and put money back in people's hands. And if inflation is going crazy, if there is a weak dollar, if you don't have the buying power of your money any longer, typically, as people have less money to spend, that begins to slow down the economy and decrease inflation. So if you're trying to decrease the amount of money people have to spend, what would you do to loanable funds? You would probably decrease loanable funds, and you would do that by increasing the required reserve ratio. When you look at discount rates, if you're trying to decrease the amount of money people are getting in loans, you can increase the interest rate. And then when you look at the open market operations, you would come back in and sell. So recognize that the policies that the Fed will follow, their monetary policy, expansionary, loose monetary policy, or in times of recession, the same formula will help. If we have a high inflation, then a contractionary or a tight monetary policy will help. Or a combination of the reserve rate, the discount rate, and open market operations.